A few of you have mentioned recently that you don't see why dividends are so important. The dividend irrelevance theory holds the belief that dividends don't have any effect on a company's stock price. And worse, that dividends can damage a company long term, leaving it without cash which could have been better spent on growth opportunities.
The implication is that as investors, we should stay away from companies that pay consistent or high dividends. In this video, we're looking into whether this has any basis and why we think those investors have it wrong. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Stake are sponsoring this video, so we want to give a special shout out to them. For those who don't know, Stake offers unlimited commission-free trading in real time and is FCA regulated.
Stake is fractional investing, so you can easily afford to buy highly priced stocks like Amazon and Google.
And Stake are giving away a free US stock worth up to $100 to everyone who signs up via our link. We'll put the link to the offers page in the description below, so be sure to check that out. Now, let's get into the video. Why not just create your own dividend? A big part of the beef with dividends is that they just aren't necessary for income, or so the dividend irrelevance theory says. Investors interested in drawing an income from their portfolios could simply invest in growth stocks instead and sell a portion of their shares every so often to create an artificial dividend for themselves.
We agree that this method does work well for a lot of investors, and we're not dismissing it. However, when stocks fall in value, such as during a recession, you risk damaging your pot by selling shares in order to create an artificial income. And selling shares lowers your ownership of the company and so lowers your share of future profits. At least if you held some dividend stocks, you'd expect most of these to continue to pay out.
That's not to say that dividends are without problems either. There is a 15% deduction taken from US dividends at source for foreign investors, which could be avoided if you drew an artificial income instead from the sale of stocks.
Share buybacks. Share buybacks are an alternative way for companies to distribute cash to shareholders without them incurring dividend tax, making it an attractive alternative to dividends. Companies can buy their own shares back from the market and then rip them up, thereby reducing the number of shares in existence. Because a share buyback reduces the number of outstanding shares, it increases earnings per share, which in turn elevates the market value of the remaining shares.
Do dividends add any value? The dividend irrelevance theory suggests that the announcement and payment of dividends should have no impact whatsoever on a shareholder's individual wealth, that they are effectively pointless. They say that whether that cash is in the hands of the shareholder or the company, it makes no difference.
If Company A has £50 million of cash and announces that it will pay £10 million of its shareholders in a month's time, an investor buying that stock now is buying part of the rights to the full £50 million of cash in the company, along with all the other company assets.
This same is true for Company B, which pays no dividend and has £50 million of cash on its books. When a company pays a dividend, the share price should always in theory drop after the ex-dividend date, because the company now has less cash on its books and so in theory is worth less.
But in theory, the wealth of the investor hasn't changed because the same money is just transferred from the company's pocket to the shareholder's pocket. The conclusion is that dividends shouldn't affect the shareholder's wealth. But of course, we know that they do, which we'll get to soon.
Dividends can damage the company. Dividend irrelevance theory goes further and says that companies can actually damage their financial health by paying a dividend. This is particularly true if the company has to borrow the money in order to pay those dividends.
And it's true longer term too, if the company can't afford to invest and grow its business if the shareholders have taken all the cash.
Thank you very much.
Our response to this last one is we don't care as long as A, the company isn't put into financial difficulty, and B, we can invest the cash better than the company can. For example, the company at best might only be able to generate a 6% return on investment, but we could easily allocate that money better ourselves by investing it in more profitable stocks.
But it is true that in many companies, the cash is better off under the control of the directors than in the hands of the shareholders. Take Amazon. Amazon don't pay dividends, and we wouldn't want them to, not yet. They can probably invest our money better than we can, in incredible technology and supply chain innovations.
Percentage returns, dividend versus growth stocks. Dividend stocks' total returns are typically less on average than those of growth stocks because they are less risky, less volatile, and typically established cash cows. They also provide a steady income regardless of the share price or the state of the wider market. The natural laws of risk versus reward kick in to give you a slightly lower return as a result.
In defense of dividends. Now for some reasons why dividends kick ass. Counter-argument number 1. Dividends as a signal of financial health. When a company who normally pays dividends then cuts those dividends, usually the share price tanks. A falling dividend is a signal that the business is in trouble. What's gone wrong with their cash flow to mean that they can no longer afford the dividend? And are their future earnings in trouble?
A chunk of any dividend-paying company's investors will be there for the passive income, so they can keep chilling in retirement without the hassle of having to constantly buy and sell stocks. This company had attracted investors who had a preference for dividends. Take that dividend away and there's one less reason to stay.
On the other side of a coin, when a dividend is declared, the share price often goes up because it signals to the market that this company is stable enough to afford this act of potential self-harm.
Think peacocks in the wild. They are practically begging to be eaten by predators by flashing those blingy tail feathers around. But the ones that show they can survive, despite flashing the bling, are the ones who get the lady peacocks.
Likewise, if a company can afford to pay sweet dividends consistently without being killed off by insolvency, their survival skills are impressive enough to be chosen by us for our portfolios.
Counter-argument number 2, stock pickers and investors need dividend data. Dividends cannot be manipulated. The amount of the dividend is a matter of fact, whereas profits and values of company property can be fiddled with to be shown in a different light. A dividend, therefore, is a solid way to value a stock. Most other figures in a company's accounts can be very easily manipulated, sometimes to the point that they are meaningless.
Knowing the dividend and its history is one of the key components of stock valuation, and it is one of the things that we look at when picking stocks.
Counter-argument number 3, costs. In terms of cost, there are trading fees involved when you sell shares to create your own artificial dividend. On most platforms, trading fees are still sky high, but I suppose this problem has been somewhat lessened by the introduction of free trading platforms like Stake. However, this still leaves the bid-offer spread, which could cost a few percentage points.
Counter-argument number 4. Dividends are in the company's control. Dividends are the company's way of rewarding their shareholders. They have no direct control over the share price. The price could go steadily downwards over the next 5 years for reasons totally outside of the company's control, but they could continue to pay out dividends consistently.
Paying a dividend can also be a company's way of saying we have too much cash. We all know how awful the return on cash is right now. If the company has run out of internal investment opportunities, then cash will pile up in the business unless a dividend is paid.
In these circumstances, the company's directors should pay out that cash as a dividend to fulfill their primary objective, often forgotten, which is to act in the best interest of the shareholders.
Question of the day, where do you stand on the dividend argument? Irrelevant or essential? Let us know in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.